we had some very dire macroeconomic data come out on Friday. Unemployment surging, jobs data just looking flat, leading all the perma bears to come out of hibernation to claim that we are finally in a recession, or if not in a recession, that a recession is absolutely imminent. So the question is this a recession warning that we should be heeding, or is it different this time? Of course it's different this time. Of course it's different this time. But we're going to discuss in this update why it really is different, and what to make of everything, why the bears are saying that the unemployment surge that we're seeing up to 4.3% means that we are in recession or very close to a recession, and why I can very confidently say, even if we end up in a recession, that we are. Absolutely. It is different this time. We are just simply in a different system state of the macro cycle than any other time when we've seen acceleration like this in unemployment. All right, there's going to be a lot of theory in this update. We're going to have to cover quite a lot. We're going to have to go over kind of what the features are and how the business cycle functions from an MMT perspective to really understand why we are in a different space right now. So I'm saying all this is buckle up, make sure we're paying attention. We're going to step through this and kind of explain why I'm pretty darn confident here that it is different this time. And I think the perma bears are once again going to be in hibernation and just a few months, one more time, kind of waiting on the next big scare to come through. All right, why was everyone thinking that this sudden tick higher in unemployment is a signal for an imminent recession? It really just kind of goes down to the Sahm Rule, and effectively what the Sahm Rule is saying is that the 3-month moving average of unemployment rises buyers above half a percentage point relative to, or half a percentage point or more, relative to the 3-month average of the prior 12 months. It's a mouthful. What does it actually mean? Pretty much, unemployment rate is accelerating. And there is really this point of no return where the unemployment rate starts to accelerate so much that it becomes a negative feedback loop on the macro economy. Now, I don't think we're there yet, and I think this is a bit of a head fake. We'll explain probably why it's a bit of a head fake at the end of the video, but to understand why we are just in a different spot this time, we need to, like I said, understand the entirety of the broader cycle that drives the macroeconomy, so the dynamics that drive the macroeconomy. Where we're going to end is on this chart, but I want this in your head before we get going as to why this is so important. Notice how at the beginning of each recession, or where we finally hit that inflection point, where we see the unemployment rate really accelerate, we get, prior to the 91 recession, prior to the dot-com bubble, prior to the great financial crisis, why in each major recession that we had up until this point, we've seen wages rising into that point. And notice how over the last couple of months, really the last couple of years at this point, we continue to see average hourly wages decrease as we're seeing unemployment increase. So every prior recession, we see unemployment increase into a peak of average hourly earnings, whereas right now, average hourly earnings are dipping much, much lower, even though we're seeing this unemployment rate push higher. This is important. This is why it's different. It all culminates into this very chart. But in order to understand why this is so important, we need to understand the entirety of the dynamics that are playing out in the business cycle. So let's start at step one of the business cycle. We just have to now take a step back. Let's go over the business cycle, what kicks the business cycle off, why there is this endogenous money creation that happens after major fiscal spending. We have to understand that entire business cycle. So let's go over the business cycle real quick. And probably the best way to start this is just to start at the end of some major crisis where we see a sudden surge in deficit spending. So after the 70s and the early 80s, we had a huge surge of deficit spending. Early 90s, huge surge of deficit spending. After the dot-com bubble, huge surge of deficit spending. Same thing, great financial crisis, big surge in deficit spending. COVID, big surge in deficit spending. And then more recently, after 2022, when the interest rates were in full effect, huge surge in spending because of the interest income. So after each one of these surges, what do we end up seeing? We end up seeing a very strong credit cycle emerge. The reason for this is that when the government spends, it's accomplishing two things for the private sector. It's creating new income, new profit for the private sector, and it's capitalizing the private sector. What does that mean? Let's start with the capitalizing private sector. When the government spends, the end game of that spending is that the private sector now holds treasuries as a financial asset, right? So when we say the government spends, it's adding net financial assets. That's what I mean. They now have treasuries on their balance sheet. And those treasuries are the safest of assets that the private sector is going to use to leverage from. So it capitalizes the private sector. The other thing that it does is it creating the initial surge of profit. When the government spends, that's a direct injection of income into the private sector. And if, let's say, you get an unemployment check, you're going to go use that to go buy something, a hamburger, whatever it is. You're going to go buy that, and that's a profit for some firm, some company that's making whatever good or service it is that you're buying. And even if you do save that, you don't spend it, that saving, like I just said, enters the private sector, in the private financial sector, and then capitalizes the financial sector to allow the expansion of credit from there. So what happens when you get a surprise in profits? Well, what ends up happening, what Hyman Minsky teaches us with his instability hypothesis, really should probably just be called the instability fact at this point, is that as profits rise, companies are more eager to take out new loans. When you get a surprise in profits, companies take out more loans, which in turn gets more surprises to the upside, and you get an expansion overall of credit and of the business cycle and of a growing economy. And this is how you get a business cycle to emerge. All of a sudden, you start seeing very strong kind of beats, very strong. Wow, we ended up seeing more profit than expected. We ended up seeing better data than expected. Wow, we can actually justify new loans. Banks also see that these that these loans are able to be paid back, so they're willing to make them. They also have a new capital base to leverage from, so they feel safe making these new loans, and you start to get loan growth that accumulates, and it becomes a positive feedback loop where you start seeing economic expansion. But eventually this comes to an end. Why does it come to an end? Why does the business cycle ever stop? Well, as business expansion continues to push out, that also means higher taxes start to accumulate, and that actually starts to kill the acceleration in deficit spending that you see. People come off of unemployment, off the automatic stabilizers, and you start to see the government start to generate a lot more revenue, killing that initial income stream. But since the credit cycle started, and since the credit cycle itself can sustain its own growth for quite some time, you can see this credit cycle kind of build upon itself for some time until you finally hit an inflection point where you're no longer getting ample income from the public sector, from the government, and the profits start to diminish in the credit cycle. And what is it that ends up killing the profits of the credit cycle? Well, it's going to be the biggest expense that companies face in terms of determining where their profit margins are at. And that's why when we started this discussion, we had average hourly earnings up. It's labor that's the biggest cost for businesses, and it's when the labor costs start to eat into profits that companies have no other choice but to start doing layoffs to preserve the profit margins that they had. Well, when they do this, when they start to lay people off, that creates a reinforcing cycle to the downside. We now have a negative feedback loop. People get laid off, which means they can't buy what they were just buying. It takes a bit of a lag for unemployment to catch in. The automatic stabilizers don't kick on that fast. And eventually it's a race to the bottom, just like at the end of the cycle, it's a race to the top. And you end up in this cascading cycle where unemployment begats more unemployment, which begats more unemployment, which is why the Sahm Rule has been so consistent and so accurate over time, because usually when unemployment is accelerating, there's nothing to stop that until the automatic stabilizers kick in. But I can confidently say that this time really is different. Why is that? Because the average hourly earnings are falling right now. They are not eating into the profit margins of the private sector. There is nothing at this point impeding the private sector from wanting to continue to expand credit. And I'll show you in just a second that is exactly what we are seeing. In fact, we are just starting to see the beginning stages of this credit cycle. So yes, we are seeing this acceleration in the unemployment rate, but it is not the sort of acceleration that is concurrent with the recessionary environment that you would expect would lead to this kind of runaway unemployment spiral. We are just not there. That's why I said at the outset, we are just in a different system state, right? We are at a different spot in the cycle. So, one, we're not seeing the most important factor here, rising labor wages or rising wages, the labor cost, impede profits at this point. Furthermore, we are just starting to see the bank credit cycle kick off here. It is just beginning the acceleration phase after a major washout in 2022. We're on our way up, not on our way down. So again, look, could we end up in a recession? Sure. Depending on how you want to define recession, maybe we do. But for my purposes, especially too, as someone who's an active trader, active investor, I need to position myself for where markets are headed next. I can see this and say, no, we are in a very different spot in terms of where we're at in the overall cycle. And what we are facing right now with the sudden shift in unemployment is not consistent with the sort of massive accelerations that we see prior to or during major crises, major recessions. This is very, very different. So what do we make then, or what can we make of the sudden rise in unemployment? Moving over to Twitter real quick, I really like what Ben Kizmchuk pointed out here, looking at job losers as a percent of total employment, showing that unemployment is rising not because people are getting fired, but because people are choosing to leave jobs and the number of job seekers are increasing, both signs of a normal economy. And again, I can pull up the chart that he just posted to look at in a little bit more detail. Really good follow. He's been having a lot of good write-ups on Twitter, just kind of pointing out where we're at in the credit cycle and the business cycle as a whole. We also just kind of mentioned in the most recent monthly outlook over at appliedmmt.com a whole plethora of reasons why, when you're at least willing to take one look below at kind of the next line item in all the jobs data, it's just not looking as dire as the perma bears would have you believe. So if you are an active trader, active investor, make sure you check out appliedmmt.com and check out that monthly outlook as well. But I think really to summarize, we're just not seeing everything consistent with the sort of signals you would want to see if we were in fact heading into a recession. So there has to be a different explanation as for why the acceleration we're seeing in the unemployment rate right now is happening that is not going to actually cause a recession. So look, I am very unconvinced that we are headed for a recession. I mean, in fact, I still think very much that in terms of the longer term outlook, we are very much on a bullish pace higher. Obviously, anything can change from here. Our process is always flow dependent. We look at the leading flows, and that is what's going to determine our process. But as it stands right now, all those leading flows continue to show expansion and growth, and we continue to be in the sort of system state, like I said, that's consistent with relatively bullish markets, despite this moment in time being a little weak. Overall, I do think that markets will recover, and in the not too distant future, we will see markets shake this off. All right. That is all I have for tonight. If you're new here, make sure you get subscribed, turn that notification bell on as well. If you're watching this on Twitter, follow me there. And then if you found this video particularly helpful, give it a like on the way out. And as I mentioned, if you're an active trader, active investor, head on over to appliedmmt.com. And if you're not even signed up and you're not an active trader, active investor, but you still want to get alerted when our various write-ups come out, make sure you drop an email, absolutely free. Do a few write-ups every month. So yeah, there is that as well. All right, that's all I have for this update. Until next time, good trading, everyone, and we'll talk to you then. Bye-bye.